All right, so here we're going to go ahead and get started. Again, my name is Bernard Jeter. I'm with Insurance Advisors Direct, and here I am, the life and annuity guy here. Today's presentation, we're going to be talking about tax diversification strategies using life insurance. Now, for the whole month of March, we've talked about the many uses of IULs from the ideal savings account to long-term care to just having a general conversation on IULs. So today we have Chris Schiefer with us, one of our trusted life partners, who's going to go over tax diversification strategies and how that will work in your practice. All right, Chris, my friend here, go ahead.
All right. Good morning, everybody. Bernard, like usual, can you let me know, is everybody able to hear me?
Yes, if I can hear you, our guests can hear you as well, my friend.
Okay, great.
Right.
So everybody on the call today, the idea here, Bernard and myself talking, trying to get you guys information to help jumpstart your life business. Okay. We want to help give you ideas when you're talking with your clients. So there's more to the discussion. All right. Ultimately help you to make more money. Right now in the industry, a really, really big concern is taxes. Okay. And with taxes, this is something that really comes into play with the planning that you put together. And I'm a big believer in the idea of holistic planning, where you really look at your client and try to pull everything together and let them know everything that's happening and how you can help them. So with the presentation today, what I hope that you will get out of it, what's meant to happen with this is two things. One, this presentation that I am presenting today, Bernard and myself are willing to do this for you with your prospects and your clients as long as you get 10 people scheduled to be on the meeting. Okay. So look at this as a way that you could use to prospect rather than inviting people to a seminar and giving them food and stuff. You can invite them to a webinar on how to get to and through retirement. All right. Any questions that come up, please write them down. We could discuss them for a bit afterwards, and we'll get going here. So when I put this presentation together, always trying to think about a way to make it a little bit catchy. And so what we need to know here is retirement is not it's not just a lap around the track, right? It's not just a sprint down the line. It's truly a long track. And what I'm trying to do is get you to think of retirement as, hey, this is something that we got to be thinking about early. We got to be thinking about it often. But if somebody has not done a significant or a really good job getting ready for retirement, you are able to help them still today. But when we look at retirement, what we need to know as advisors and what we need to expect our clients / prospects to be able to tell us is where they want to go, right? Please, as the advisor, don't be shooting in the dark. Don't be trying to concoct or come up with something out of the blue. Get them involved in the conversation. This is how you win your client, okay? So they need to pick a destination. They need to let you know what that is, right? So again, what they're going to do is there's the classic scenario, right? Where somebody retires, they play golf. Maybe they aren't worried about golf. They just want to retire someplace where the weather's nice. Maybe they're very comfortable and happy that they got their home paid off. They like where they are, and they're just looking forward to being able to relax with their significant other. Listen to the Yankees game or the White Sox game on the radio, watch it on TV. They want a garden in the backyard, whatever it might be. I guess for you guys, it'd be the Tigers game. But, the thing is, you have to understand what it is they want before you truly could help them. Okay. Once you know where it is or what they want, now we need to map the course. Okay. So again, think about retirement, right? If you were getting ready to go from Detroit, Michigan to, I don't know, Alberta, Canada, you're not just going to get in your car and go, right? You're going to look at a map. You're going to get an idea on how to get there, right? You're going to try to maybe do a little research with what's available today to make sure that you're not going to run into closed roads or whatever it might be. That's the same thing with retirement. We have to know where we want to go, but then this is the point that you step in and help your client to map that course. And when you're mapping the course, what we need to make them aware of is the obstacles that come in front of them as we do this. And there's really two obstacles or two different types of obstacles. There's the traditional obstacles, okay? When you think about these, right? If you remember when you were younger, your parents, maybe your grandparents, an aunt and uncle, whatever it might be, but they told you to put as much money as you can into your retirement, right? Save money, save, save, save. Some of us might have been told save 10% of whatever you make. Other people are told something different. It doesn't matter, but we've been told save. And clearly, right, that advice is timeless. It still stands as well today as it did 50 years ago. And that's because many of the obstacles are the same today as they were 50 years ago. The other thing, though, that we have to realize is that there's new obstacles, right? So when we look at these obstacles, we need to realize what they are. Quick overview, we got people living longer, market risk, and inflation. And when you think about that, all of these things run together, right? Because you're living longer, you need your money to last longer. So you either need to make more money when you're working, or you need to save more money while you're working, or you got to take more market risk to make sure that you can get the returns you need to have your money last. And then, of course, the longer that we're alive, the more opportunity we have to deal with inflation at different times. So when we think about people living longer, this is the big thing that I talk to folks about. If we look at the lower right-hand corner, if we got a couple that's 65 years old, here's the deal. Based on the 2012 mortality tables, right? The people in that couple, they plan to live 103 years, that to the age of 103. That's 38 years. Okay. Let's look at a couple that is 65. When you look at it this way, you're looking at 29 to 38 years, right? I should have said it that way to begin with. Sorry, I just had a call that came in, threw me off there. But we're looking at 29 years to 38 years, right? Let's just call it 30 years. Okay, folks? Think about the first 30 years that you lived on this earth. What did you do? You did a lot, right? You did an awful lot of things. You accomplished a lot of stuff. You learned how to walk. You learned how to run. You learned how to read. You learned how to write. You learned how to do algebra. You graduated high school. You went to college, maybe. You graduated college, maybe. You got your first job, right? You learned how to drive. You got married. Maybe you had some kids. Shoot, depending on what age you were when you had those, by the time you're 30, you might have had some kids starting middle school or high school, right? I mean, folks, you accomplished a lot in your first 30 years. And so what I want you to know is your clients, they stand to live a whole other lifetime in retirement. See, it's not like your grandparents or the people that came before them where they worked till they were 55 or 60 and then planned on living for 5, 6, 7 years, going around the country, and then maybe they don't, they pass away. Okay, people are living longer, they're living healthier, they're living fruitful lives. We need to make sure that they got the money so that they could do that. So because of this, the traditional thing that happens is a lot more of our money is invested, right? And as you can see here, all the way back to the 70s, every decade, we had pretty solid declines. I mean, and we're in another one right now. You guys understand the market risk that's out there. And I'm not here to say that the market's bad, that the market's not good, because it is. People need to be in the market. It's just a matter of how much, okay? Understand that when it comes to the market, it's really more about a couple of key years in somebody's life. It's a couple of key years in their planning, okay? And what that is it's like a year or two before retirement, the year of retirement, and the year after retirement, okay? Maybe it's a year or two before college, the year that you start college, the year after that, right? When we start looking at periods of time, this is when we have to look at our money, and this is when the market becomes a scary place. Look right here. Basically, I have two scenarios with the same washed out return. All I did was I flipped the numbers around. The first person gets 27 the first year, the next person gets negative 15. And you can look at the numbers flipped. But here's what happens with that. This is why sequence of return is so important. The person who had the 27 the first year, his or her money is going to last an additional 13 years, even though over that 4-year period of time, they got the same return. Okay, folks? So it's not about saying, hey, the market's bad. It's about saying, hey, there's periods of time when we need to make sure that we're mitigating that risk. And this is where Bernard and myself come in to help you do that with your clients. Bernard's really good at this and helping you with some products where you could get the upside of the market without the downside. And he could help you with that. Okay. Inflation. I don't think I really need to go into it other than say this slide, when I put it together, made me jealous. You look at all those movies back in the day, those guys driving all those souped up cars that sounded cool. It's like, man, get a GT Mustang for $3,000 in 1968. But here's the deal. Some people are going to say, well, you didn't make as much money then. True. But the actual value of the dollar went a lot further. Okay. So it's not exactly equal when you start thinking, oh, you didn't make as much money. Because somebody in 1968 making $30,000 a year, they could buy this car, they could buy a house, they could have sent their kids to private school, and they could have paid for them to go to college. Okay. Today, that's not happening with certain people who still might be able to afford a Mustang today. But the point I'm making is understand inflation is powerful, and inflation's a thing that you got to put into understanding, right? So what does it mean? Why is it on there? Well, you can't just automatically take away the idea of getting market returns or market type returns, because then inflation becomes a very scary place. Because, you could sit there today and say, hey, I could go to the bank and get a 5% return or a 4% return on my money. What's inflation sitting at right now? What are they saying it's at? 8 or 9%? I mean, am I right on that or wrong on that? 8 or 9% inflation. Well, you're losing the purchasing power of your money by the day if you sit in there and get 5% on your money. On top of the fact that you then have to pay taxes on that 5%, so it's even worse. So it's not to say that people shouldn't have money in the bank, but what it is to say is they can't have all the money in the bank. They still need to have the opportunity to get upside market returns. All right. When we look at the new obstacles, okay, when we look at the new obstacles of retirement, we're talking about Social Security. Each and every day you have clients, you have friends, you have neighbors that say, Social Security isn't going to be there for me, right? People are worried about that. Diminishing pensions. I started in this business in 1998. About 50, 60% of the people, about every other person I saw had a pension. Today, nobody. Practically nobody, right? And taxes. Okay, the national debt and how that's affecting taxes. So let's talk about Social Security and why you need to be making your clients realize that now is the time. Social Security gets looked at by the government on a 75-year solvency deal. The next time that's really coming up is 2035. Hey, I just find this interesting that it is closer to 2035 than it is to the year 2000. You believe that? Man, I remember 1999 going into 2000. Everybody was scampering around like little mice, worried about what was going to go on, right? You all remember that? It was kind of crazy. But check this out, man. We're at 2035. It's right around the corner. Time flies. It's a little bit off topic, but the point I am making is the time is now to plan, right? Time gets away from you. And one of the things they're looking at is a permanent payroll increase. 3.65 percentage point payroll increase. What does that mean? Everything being equal, your clients are going to be bringing home less money in 12 years, right? more of it's going to be going to support Social Security. Your clients need to realize that when they sit there and tell you Social Security isn't going to be there for them, all they're telling you is I need to save more money, but they don't realize it. They're just complaining. But you're the person that's there that's able to make them realize, hey, listen, let's start taking 3.65% of your paycheck, 5% of your paycheck, whatever it is, small amounts, and let's increase what you're saving. Whether you do that with an IUL, whether you put that in an investment, whether you put it in a bank, whether you stick it in an annuity, whatever it might be, use that to your power to say, hey, let's not let that catch up on you. Because the reason is, what's more likely is they're talking about a reduction in benefits of 23%. 23%, I don't know if anybody's grasping what that is, but if you take 23% of $1,000, what is that? It's a lot of money. Rather than getting 1,000, now you're getting $770, I think, if I'm thinking right. That is something, right? But you're perfectly positioned with the help of Bernard to show people that why would you want to sit back and risk this happening to you? Let's start now. Now's the time. We got 12 years before they might increase what they're taking out of your paycheck. Let's start now. Let's put money away for yourself and see if we could build our own pension that's going to make sure that that 23%, no matter what, is always taken. We don't have to worry about it. Oh, well, hey, Mr. Advisor, what if they don't do that? Listen, here's the biggest thing in financial planning, okay? Here's the biggest thing in what we do. You need to know this phrase. Write this down, okay? Everybody write this down. Plan for the worst, hope or pray for the best. If we plan for the worst and assume that it's going to be 23% reduction, okay, and they end up not doing that reduction, what does that mean? Oh, now rather than your client getting $1,000, they get $1,200 because they save some extra money with you. I don't know who's going to be complaining about that, right? Really, what's going to happen is probably some combination of both. But folks, the bottom line is Social Security is a spot that you could talk to people about. Make sure that they understand they need to take advantage of the time they have and get that difference made up. And you're there to do that for them. Pensions, if any of your clients have a pension, that's great, because today most people don't, right? They're too expensive. All right, we're not going to talk about that. Let's talk about debt. Okay, my screen says 23 trillion. The truth is we're $31 trillion in debt. I did this right before COVID, okay? Did it right before COVID when I put this together. Started actually going around the country, giving this presentation to advisors, started doing webinars, giving it to advisors. I chose to leave the 23 trillion on there because I wanted you to realize that things happen in life. And we had one of those things happen called COVID. Within a matter of 2 years, that national debt went from 23 trillion to $30 trillion. They started pumping money back into things. Okay. Today it's 31 going on 32. By the year 2026, they're saying it could possibly be $40 trillion. What I want you guys to do, because you're just sitting here hearing me throw around numbers, 20 trillion, this, that. Let's just talk about a trillion. Okay. Let's talk about $1 trillion. If we have $1 trillion bills, right? We have $1 trillion bills. Shoot, we have the $100 bills that it takes to make $1 trillion, right? They weigh about a gram, okay? And when you put all of that on a scale, if you weighed it, it'd be 2.2 billion pounds. Damn. I'm talking about I got to lose 60 lbs. We're talking about this stuff here is 2.2 billion pounds. I don't even know if you could grasp what that weighs, what that would do. Okay. Here's the bottom line. 2.2 billion pounds. That is more. That weighs more than 630,000 mid-sized cars. I'm going to look something up while talking to you folks. Okay. I'm going to look something up right now. Google population of Detroit, Michigan. I'm not talking about the metro. I'm talking about the city of Detroit. 632,464 souls live in the city of Detroit, Michigan. $1 trillion, if you were to weigh it, weighs more than every single person's vehicle combined. Okay? Understand that. And we are talking about almost 40 times that amount in national debt. Listen, $1 trillion, those 630,000 cars, you could buy each one of them 8 times. I'm sorry, totally messed it up. You could buy each one of those 385 times. I get a little bit animated, folks, because when I did this, I was getting blown away by the numbers. Me and a small team, we were working on putting this together back some years ago. And I was just joking with you when I said 8 times because you thought that was a lot, right? 630,000 cars, buying them 8 times. But it's actually 385 times. That's $1 trillion. Our country is 31 trillion, 30 times that in debt, going on well on our way to 40 trillion. So the bottom line is what happens, right? When we look at debt, there's 2 ways to offset that. They could spend less or tax more. Biggest question I have for you is what's more realistic? Okay. What's more realistic? So when you think about this and you think about your own practice or you think about your own prospecting, let me give you a tip on how you could prospect. Here's the question. Our country's $31 trillion in debt. Mr. Jeter, do you believe it's possible that taxes can go up in the future? Right? He's shaking his head yes. Everybody you talk to is going to say yes, unless their head's been under a rock, right? The point I'm making is you could lead people to the water. Ask them, do they believe taxes will go up? Because if they do, you're uniquely situated to help them start saving in a way that you could build that bucket of tax-free money. Because I'm going to tell you this, they're not going to lower spending. They really can't. So 2018, we had some new laws that went into effect where they lowered taxes for some individuals. 2026, that's going to be coming back. There's a sunset. But ultimately what they did is corporations got to keep that lower tax rate. I don't mean to go political here, but it was all a little bit of a smoke and mirror deal. Hey, we'll give you, the populace, a little bit of a tax cut today. In 2026, it's going to sunset back to what it was. But really what we're trying to do is get the corporations a lower tax rate. Theirs is not going to sunset. Whatever, right? Whatever. You could debate that all day long, but it is what's happening. The bottom line, what it means is each and every individual you talk to, we're the ones that have to bear the weight of the debt. Okay? They're going to come for us. Taxes. If you think, hey, they're already taxing us through the nose, I'm going to tell you we're in a historically low tax environment right now. If you look at my chart, 1938 to 1983, okay, the top marginal federal income rate was around 70%. What you'll notice there's many years it was over 80, sometimes over 90%. When they need the money, they'll get it. Just a talking piece here for you. Bottom line on what happened was we went into a couple of wars. We started spending a ton of money on that stuff while continuing to lower the tax burden for corporations and other people, right? We were bringing in less money than was going out. As such, we have a huge national debt. But today, what's come of that is the interest. Okay, the fastest growing expense in the federal government is interest. Within 10 years, we could be paying more for interest than national defense. That's from David Walker. I don't know if you all know who David Walker was, but he truly was America's CPA. He had the checkbook for our country, and he wrote those checks. He paid the bills, all right? And so he made that statement back in 2018, all right? So even if we were to try to lower spending, the problem we have is our national debt's so high that the interest is just, astronomical. Okay. So when we get to this and we understand these problems, right? We understand that, hey, Social Security might be decreased. We understand that taxes are going to go up. We understand that people might not be saving as much money as they once did because the cost of everything's so high with inflation and everything going on, right? What we need to look at is we need people to understand to reach the goal, we got to understand that, and we got to understand our money. And when we look at money, we essentially have three types of money, okay? We got taxable money, we got tax deferred money, and here's how you're different than every other advisor on the block up there in Michigan is you're going to help your clients, and you guys coin the phrase, start saying the phrase, how you're different than Edward Jones, how you're different than the Morgan Stanley guy, how you're different than the guy at Northwestern Mutual, okay? You're not only going to help your clients save money, you're not only going to help them be protected, but what you're going to do is help them become tax diversified and get as much money as possible above the line. Tell people I focus on tax diversification and helping you get money above the line. Okay. So when you think about this taxable money, what is that? It's your income. Stocks, mutual funds, CDs that are non-qualified, right? What's the tax deferred money? It's IRAs, 401ks, 403bs, 457 plans, annuities, things like that. These used to be the big thing where everybody put their money, and quite frankly, they still are today. Most of your clients that you talk to, over 90% of their net worth is going to be in these type of accounts. And I'm going to tell you it's still good, it's still needed today, but the more money they have in these, all they're doing is creating a tax time bomb for themselves. We need to work on getting some money out of here and getting it above the line. We need to work on them building a bucket of money that'll help them ultimately have a third of their money above the line. So when we start talking about how do we get money above the line, right? Well, what do we do? We need to look at financial vehicles that are purchased with after-tax dollars, okay? And that'll grow and then give us the ability to be tax-free on the back end. And so when we look at those, we have muni bonds. Not many people, unless they're ridiculously rich, have them. We have the Roth IRA, great account, but it does have income qualifications and contribution limitations. And then we have cash value life insurance. You could call it the 7702 plan if you'd like to. Look at the bottom of my screen and you'll see Internal Revenue Code section 7702, right? That's just that's the IRS code for it. Just like 401k is code for a 401k plan, which is a pre-tax, tax-deferred plan where you partake in that with your employer to save for retirement, right? Let people know 7702, that's the tax code for cash value life insurance. Why does it work so well, right? Well, it's got a self-completing feature. The money's going to grow tax-deferred. You could take it out tax-free. It has living benefits, protection from creditors, depending on state. But above all else, there's no market risk with the type that Bernard's going to talk to you about, right? It's going to give you the upside of the market without the downside. It's going to protect your money. So every time your money goes up, it gets locked. Every time it goes up, it gets locked. If the market goes down, the money that you made, it's locked. You don't lose any of that, okay? But what you'll notice is with the annual reset, which is the most powerful thing in the financial world today, is even though the market went down, your account that you have resets. It restarts from this down point in the market. And now when it goes up, you make money off of that. Where if you were in the regular market, right, and you made money back, you're still well below where you started when you started losing this money, okay? This is why when you look at an index product, you don't need to worry about, oh, I got to get 20, 30, 40, 50% returns to be able to keep up with the market because you're never having to deal with the downturn. It's huge. And we could talk in further detail with that at some point with you. But what I want you all to understand is this. Do you really want your clients to be relying on the government, right? Do you really want Social Security to be their sole source of retirement? Do you really want the money that they have in 401ks and stuff to be at the mercy of what the government does with taxes? When we look at this, wouldn't it be nicer to have your clients pay tax on the seed, right? Picture a handful of seed. pay the taxes on whatever that costs, versus take that seed and whip it out in a field and it grows a bunch of corn or whatever it grows. And would you rather pay the taxes on that, right? And then when it comes to the market, right, we can't decide or time the market. Okay, we can't do that. Time is now. The market's down. The time is now to get money into an IUL and to do that, because you're going to have such great upside to make huge money in the coming years. So the next step for each one of you, okay, I'm hoping as I went through this, on that piece of paper that you wrote some notes. I'm hoping that you had a few names that came to your mind. I'm hoping a couple of people you thought about. Hey, they need to start saving. Hey, they asked me how they could start saving. Hey, all their money is in tax deferred type accounts. Think of some of these people, get these names down and get a hold of Bernard so he could help you out. Let him give you some comparisons and some ideas so you can see how it works further. So again, folks, I really appreciate you listening to me here today. And that presentation, I gave it to you as advisors. When I give this presentation, if you would like me to give it to, I'm going to say a room full of people, but really it's going to be a computer full of people. You get 10 or 15 people onto a webinar. And again, I suggest you go for getting 15, because then we'll end up having, 8, 9, 10 on there. I'll give this presentation and it'll be a little bit more geared towards your client and helping them to understand what they need to do to get going. Okay. I'll slow down on certain things and elaborate a little bit more. But if we got a question or two today, I would gladly answer that for you.
So yeah, folks, if you have any questions, shoot them out. Actually, what I will do, I will, instead of folks having to type it in, you let me open it up and be able to have an outright discussion.
I normally get a bunch of questions. Really, no question is off limits. Go ahead and ask.
Let's see what we have here.
Are Fidelity Roth accounts good candidates for this? My answer to that is, Roths are good accounts, right? They really are. But kind of my answer, Tracy, is, do you work for Fidelity? And if your client put money into a Roth at Fidelity, does that make you any money? All right. And I'm not saying that we just try to push one way or another, but with Fidelity, they're probably not going to have an advisor that works directly with them 100% of the time, very in detail. Okay. They might have somebody who helps open up the account and does stuff like that and answers a question here and there. But when you get to the brokerage houses, they're usually working with their people that have millions of dollars more. So the service isn't as good. Secondly, it is a fully invested account with Fidelity, which again, there's nothing wrong with that. Okay, nothing wrong at all. But I think for you, what you need to look at is, hey, when somebody gets a Roth IRA, there's going to be income qualifications. Okay, there's going to be contribution limitations. They have to keep the money in there for 5 years and be age 59 and a half before they could take the money out. You work with Bernard on something, he could show you something where the person doesn't have to wait till 59 and a half. Okay, they're able to take money before that. They could put in as much money as they want. Okay, and they're going to get the upside of the market without the downside, so they're going to be insulated from those losses. So I often tell people, is it a good account? They're both very good accounts. It just comes down to your client, and ideally, I think every client would have both. So I hope that answers your question. Oh, Tracy, right here, I'm looking. You want to protect it from market downturns? Yeah, you need to talk to Bernard. Hopefully, I answered that. So yeah, Bernard could help you protect that money from downturns. This client that you're talking about, get their name, get their date of birth, get the amount of money they have in their current account and what they're saving. Get that over to Bernard. He could help you out. Okay. All right. Does anybody else have any questions?
I see Kapu has her hand raised.
Yes. Chris, I have a question. To talk about what the balance is, I'm not a licensed financial advisor. So I find it a little bit difficult to talk to people about that part. So do you have any suggestions how I would get around it? Or I know I have to take the test. It's going to be a while. I got other things going on right now. But in the
Yeah,
meantime,
yeah. So what you need to do is again, I know that IAD and Bernard, they have a group that they're working with if you come into a client that has a heavy swing on the security side of things, okay? But what can you talk
okay.
about? Well, just don't dig into it with a fine tooth comb, right? Stay high level and just talk about the fact of like, you know, if they're in a Roth IRA, the most they could put in is 6,000 a year. If they want to
Mm-hmm.
put in more, you have an IUL that could help them put in more. Um, if their risk profile is changed, right? They decide they don't want to be taking all that risk. Okay,
Mm-hmm.
well, let's keep your Roth IRA where it's at. Let that do what it does, but let's stop contributing. Let's take that 6,000 and start contributing it over here in an IUL where you could still get upside market, but we're going to mitigate your risk. Okay.
Okay.
Um, just don't go into it with a fine tooth comb. Just, talk about their risk profile. What do they really want to do? Is it worthwhile having 100% of your money in the market, or does it make sense to have, 80% of your market or 80% of your money in the market and the other 20% have some of it in the bank and have some of it in an IUL that gives you the ability to still get 10 and 15% returns, right? So you could talk that way with people.
All right. Carol has her hand raised.
Yeah. What, Chris, you mentioned the the disadvantages of a Roth. You said about the cap and age 59 and a half and the mitigation of risk. What was the other, was there any other disadvantages of using a Roth?
Well, let's all be clear on this call. There is nothing bad about a Roth IRA. I want to be very, very clear. But what happens is you have income qualifications, right? If you make too much money, you can't put money into a Roth IRA.
Okay.
And once you hit $6,000 in a Roth IRA, you can't put in any more. So if you got somebody who wants to save $10,000 a year, they can only do 6.
Okay.
And then, of course, you have the 59 and a half rule and the 5-year rule. Okay. So when you look at an IUL, somebody who's 40 years old, they could take money out when at 41 if there's money in there and they want to, right? You don't have the 59 and a half and the 5-year rule. The other thing is if somebody wants to put in 10,000, they could put in 10,000. Okay. But yeah.
Yeah, well, because I've had some, I'll call objections to exploring this over the fact of, oh, you mean like a Roth. And so this will help me to have an address back as to why they should have other considerations that consider other things than a Roth alone.
But yeah, and the other thing is if your client is already in a 401k or a 403b or something like that through work and it's invested in the market, again, we're not trying to say that that's bad. That's not what I'm saying at all. But what I'm saying is you might want to talk to your client about, hey, wouldn't you like to have something that reacts differently, right? Something that insulates you from the downside of the market, but still gives you the upside. So, if we use an IUL, that allows you to invest even more aggressively inside your 401k, right? So you could talk that way too, that like, hey, what we're trying to do is get you fully diversified all the way around. And, that's that. We're not talking about putting 100% all your money in the IUL. I mean, if you want to, you can, but that's probably not the right thing to do. So just make sure that they understand that. Okay.
Okay. Diversification. Okay.
Mm-hmm. All right, folks, we have any other questions? Nope. So yeah, actually, before we get into that, you know, and then Chris touched on a lot of different things, and I do like actually the whole presentation. The one part we talked about plan for the worst. When I first started out as a financial advisor, had a couple, actually a friend of mine was a sports agent. A couple of clients were athletes. You know, can't give out their names though, but that was my whole style of planning. Is like, you know what, we'll plan today. Let's say if tomorrow you break your leg and you won't ever play, and then this is how we're going to plan for your retirement. Is we plan for the worst and then hope for the better in the longer years. One other thing I want to say is tomorrow, for folks that's here in Michigan, or you can also, it'll also be live stream, is our annual sales summit. Actually, we have it twice a year. So tomorrow we'll have Medicare folks there, panel discussion with Medicare carriers, as well as panel discussion with agents. And then I will also be giving a presentation on long-term care, Christy and myself. She'll be doing the legislative side of it, and I'll be talking about the many different products or solutions that can help your clients with long-term care. Now, as an added benefit, and you guys are the first to hear this, now when you become a part of IAD's Life and Annuity Initiative, and through a vendor that we work with, or another a life insurance specialist company that we work with, we have an incentive for folks that's going on starting April 1st to June 30th. And then all business must be written by October 31st. And there, if you, 3 different tiers, if you 10,000 in target premium, you'll be able to pick an award or a gift. 25,000, you pick a higher quality gift, and 50,000, you'll pick a higher quality gift. So more information to come. It has to be written with companies through IAD, and it's actually specific products, but I have more information out to you guys, and which is really going to be a huge hit. I'll be reaching out to everyone today, and hopefully, you know, I'll see some of you guys tomorrow at our sales summit in Troy. If not, it'll be, like I said, it'll be live stream, and let's make this work, folks. So everybody, you have a good rest of your week. Chris, thank you again, my friend. And like I say, I'll be reaching out to you, talking about tax diversification and actually IULs and how this may work in with your business. All right, take care, folks. Bye.